Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you on your screen the stocks that will be featured in this recording. And as a quick reminder, you can go directly to any stock that you might be interested in using the chapters feature on this recording. All right, so let's take a look at the chart of the markets. So we look at the SPY, and I talked about a couple of weeks ago, I didn't like this gap up. I do like the fact that we broke above 575. I wish it wouldn't have been a gap, but we gapped up. We came back down, tested the gap. I would have preferred it would happen a little bit sooner, but nonetheless, we tested 575. That was resistance and now acted as support, and we're trading back above the 10-day moving average at the close on this Friday. Notice in this pattern here that we have this zigzag with that B wave right around the 60% level and the 161.8% C wave extension, which happens quite often. And while I'm talking about zigzags, just this past week, we had our ZigZag Masterclass. A lot of you signed up for it, but if you didn't get a chance to watch it live, I want to give you just a tidbit of it. So let me go ahead and change my screen here real quick. So as you can see on your screen, this is a candlestick chart of the market for those of you that are candlestick charting fans. And it's pretty easy to see that on the way down, we had a very classic zigzag pattern moving lower. That's not the thing that I wanted to share with you that is completely different, that I literally haven't seen before. That's one of the great things about trading. I've been trading for over 28 years, and there's something unique right now, especially in the world of zigzags, that I like so much. So following that C wave low on the way down, we have this current zigzag, which I just showed you on the regular chart of the SPY. And then within that C wave, there are two complex patterns. So a complex pattern simply means a pattern within a pattern. So within this C wave, there's another zigzag with the C wave extension. And in the C wave of that zigzag, there's yet another zigzag. So it has a complex C wave. And note, this is the unique part. All three of those have a C wave extension at the exact same price. And it happens to coincide with those highs that the market had back in February. So even though I've seen complex C waves and multiple complex C waves numerous times, and usually, honestly, the extensions are somewhere in the area, but I haven't seen where there's been three separate zigzag patterns, so the original pattern and two complex zigzags, all giving the exact same price, which means there's a very high likelihood, nothing's 100%, but there's a very high likelihood that we are going to test those February highs. So at this point, I'm going to go ahead and switch back to the regular screen. So here we can see that extension pattern as well as the previous wave 5 high that occurred back in February. And that's where it looks like we're going with those multiple zigzag extensions, all giving us the exact same price. So nothing's 100%, nothing happens every time, as I mentioned, but this looks like where we're destined to move on the S&P, but pretty wild stuff. And if you missed that zigzag masterclass, I'm going to put the link in the screen. If you signed up for it, you can click on the link and you can watch the recording of that class. A lot of people have talked about, why do you consider a zigzag a directional pattern? It's a corrective pattern. We go through all that in detail on why it's labeled a corrective pattern and why it works as a directional pattern and how well it works in a wave 3. Every 5-wave impulse pattern starts with a zigzag. Not every zigzag turns into a 5-wave pattern, but every 5-wave pattern starts with a zigzag. So it's great information if you'd like to take a few minutes to look at the recording. So click on that link there and you'll be able to view it. All right, with that, let's go ahead and move on. We'll take a look at the VIX. The VIX is staying slightly elevated, and there was some commentary from some of the market pundits that are concerned about this elevated volatility in the market. You can see we're holding at the 17.5 level, trading above it today. But that seems to be a support area here on the resistance area of 17.5 back in February. We broke above it. We tested it back in March. We backed down. We've tested it a lot. We tried to break up. We broke above 22.5 for a short period of time. We're back down here. So we are lower, but we're still slightly elevated, which means option prices are a little bit higher. We have to keep in mind that we could have a little bit more volatility moving forward. So at this point in time, let's take a look at the bond market, because that's where all the action is. We go and take a look at TLT, that's the 20-year. Remember, prices and yields move inversely, and the TLT represents prices on the 20-year. So yields are opposite with this move to the upside. We did have some big news last weekend from Japan, where their bond market basically imploded. And is that what put a bid in the U.S. Bond market? Because we had this big zigzag down to the downside. We hit the 138.2% level. I don't often have that as an extension level, but that's exactly where we hit and moved back to the upside. I was surprised that we broke below 100% on the extension, especially when the B wave was only 38.2. But we did nonetheless bounce off a fib level. That's why you need to pay attention to them. And you can see this move up here in prices and therefore down in yields. That will be constructive long term. The question is it because of the implosion of the bond market in Japan that's bringing money in here, or is it an aspect of liquidity? And I believe we have a chart of Fed liquidity that I'd like to show you now. And last week, I had a question on the market update on everybody talks about Fed liquidity, exactly what it is. And I put the exact formula in my response. So go back and look at last week's recording if you're curious about that, on what the exact formula of Fed liquidity is. In general terms, it's allowing the banks to lend more money. And if the banks lend more money, companies and individuals can borrow money and have more money to spend in the economy. And all that money eventually works its way into the markets. So we'll come back here and take a look at what's going on with TLT. But you can see on that Fed liquidity chart how there was separation, and the Fed has recently been injecting liquidity back into the market. That'll be helpful. Even though the Fed is on pause as far as cutting rates, they're behind the scenes injecting liquidity. So you can look at that chart and see that it was a little bit of a tick up. That will be helpful or supportive to the equities market. So jumping back over here to the SPY, I'm looking at that chart. That can give the ammunition we need to go up and hit those recent highs back from February. So we'll see how all that stuff plays out as we move forward. I know a lot of you like the TNX, so we'll look at that. This is yields and rates on the 10-year. And so you can see the opposite here. This is moving down because rates on the 10-year are moving down. The yield curve is no longer inverted, and it's steepening slightly, meaning that on the longer end of the curve, interest rates are higher, which is what's supposed to happen when you have a steep yield curve. That means that shorter maturities have lower rates than higher maturities. We're not steep yet, but we're steepening a little bit from being inverted. So that's helpful as well. And so here are yields coming back down, and that can work out well. You probably saw the news that on Thursday, President Trump invited Fed Chairman Powell to the White House. We haven't gotten a whole lot of detail there. Most people are just speculating that he was trying to put some pressure on Chairman Powell to cut rates. We know that the administration wants to cut rates. Maybe they were talking a little bit about what happened in Japan with the bond market. We don't know how intertwined some of the U.S. financials were with Japan. All that's going to play out over the next couple of weeks. So it helps to keep that elevation in the VIX as far as where we could go from here. And when we take a look at the chart of the DIA, we look here, and I think this chart is quite interesting. We are consolidating right underneath this resistance level at 420. We've broken above it on the SPY. We still have some room to go to those February highs, but look how much room we have on the DIA. I think there's a good argument to be made. Maybe it happens, maybe it doesn't, that the DIA or the Dow outperforms the S&P moving forward. We've had a bid in the Mag 7 stocks, the big tech stocks, but maybe we go back to the good old-fashioned Dow here for some outperformance if we can break above 420. But we got to break above it with a follow-through day. We tried to break above it in the middle of May, and we didn't have a follow-through day. We closed lower the next day, and it gave up that 420 level. We found support at the 50-day moving average, the royal blue line. We're back up here, so maybe we can break above it and move higher. I think that's going to be really interesting moving forward. Let's take a look at the dollar, which is actually working out well for all these markets. We're just kind of hanging around here in this 100 level. To me, that is very constructive. I don't want to lose the dollar. If we lose the dollar, then we have all kinds of problems. We're in a world of hurt. But for now, the dollar is staying stable. That's good. That's supportive moving forward of the equities markets wanting to move higher. If we move over to the Qs, taking a look at that market, We had a really nice move on the gap up a couple of Mondays ago. We ran up to the next level of resistance at 525. We've backed off a little, but you can see that a nice close today. We traded below the 10-day moving average, but we're able to get back above it. If we can break 525, we're going back to those February highs. But see, there's not a whole lot of room there. So that would be an easy trade, but it's not a lot of movement before we bump our heads again. Where the wave 5 just barely took out that wave 3 back in December. So we have the wave 3 high there, the wave 5 high in February. I think we're likely to go back to that level, but there's not that much movement, not as much movement as the potential in the Dow. So we'll see how that plays out. And then we go over and look at the IWM. And if we take a look at the IWM, you can see that it's acting not the way you would expect with rates moving lower. I would have thought with rates moving down that we would have gotten a renewed bid in the IWM. It's one of our alerts that we have currently out on the TradeFinder case study considerations. We'll talk more about TradeFinder in a few minutes, but right here around the 10-day moving average is where we're holding on the IWM. As long as we can stay above that big round number of 200, we're above the 50-day moving average. I think you could stay long the IWM. I still feel like there's a great chance we go up to 220. The move from 220 down to 200 was rather abrupt, so there's not a whole lot of resistance here. Whenever the IWM is ready to go, it'll be more of a risk-on type trade. That'll move into cryptos and stuff, which we'll talk about in just a second here. But I feel like there's a pretty good movement here to be made in the IWM. We just need to have a little more calm, I think, from the bond market, and interest rates continue to drop a little bit. And then we may see some big up days on the IWM. I think that's going to be really important to take a look at as we move forward. So when I talked about the TradeFinder, I'm going to show you what was a previous TradeFinder consideration. This was just a couple weeks ago where we had NTES, and you can see how we moved up here. This was an AI result from the folks at hubb.com. If you haven't gotten a copy of this software, go to hubb.com. You get Elliott Wave for free. You have the opportunity to subscribe to the AI signals if you want. There's a special offer in that ZigZag masterclass as well if you want to try to get it at a discount. But you can see that we had this target here and we blew through it. It was a great case study consideration in TradeFinder, and that's where it came from. So take a look at that if you'd like to, on whether or not you're interested in AI signals, etc. As we move forward. And going to skip around a little bit here on SNOW. Also a TradeFinder alert that we're looking at the potential continued move here to the upside up to this target at 261.8. So that's our current case study consideration, and you can see nice update today, and there's our target there at that fib extension. So it ties right into the whole zigzag theme. So if you want to really learn the way I like to trade, not that I'm trying to say that I'm God's gift of trading or anything along those lines, but if you want to learn more about it, those are a couple opportunities to do it. Watch TradeFinder, watch that ZigZag masterclass, etc. And let's move over to the crypto space, as I mentioned. And I know some of you made a comment that you like IBIT. I still like BITB. Both of them are optionable. Both of them have good liquidity in the options. The charts are fairly similar. There's not really a big difference between the two. You may have a personal preference between BITB or IBIT. But you can see we broke down below this support level. And if you're long anything Bitcoin, you want to see us bounce back up rather quickly from this support level. Because if we get a follow-through day to the downside here, we may come down and test this support level on BITB. And that could occur rather quickly. So we would like to see Bitcoin, if you're long that space, break above this level here at 57.5 and not move all the way down here to 52.5, which we're in danger of at this moment. Something that I've been looking at lately that I mentioned is ETHW. Ethereum has been lagging Bitcoin for quite some time, pretty much ever since those Ethereum ETFs were approved and came into being. It's like there was a lot of buying there, and then there was a vacuum, and we had this big move to the downside. But now we're starting to see a renewed move, and you can see we're holding the 10-day moving average and going sideways for the past 2 weeks here, right at this support level. If we can get a little bit of a bounce up here in Ethereum with a follow through, we're having some trouble with this consolidation right here from February. But if we can break above that, I think ETHW goes up to 25 and could happen rather quickly. So I think that's something to look at in the Bitcoin space. Moving over to the metals, we'll take a look at gold real quick. And gosh, that's been all over the place. But we're just in the middle of this big triangle. Looked like we tried to break out. We came back down. It's a larger triangle. GLD loves to do this, consolidates, breaks out, consolidates, breaks out. It continues to do that. And then we have a fairly large triangle here. So something's getting ready to happen with GLD. We've talked about how SLV doesn't seem to want to follow along with gold. It's been going through a consolidation even longer than GLD has and hasn't had the big upward move. It had a slight upward move, but not to the degree that GLD did. GLD has reasserted itself as big brother, but does the little brother catch up? So do we have a breakout to the upside on SLV and it runs up to catch GLD? Or do we go back to the chart of GLD? And anytime you have a triangle like this, you have to respect the possibility of a downward breakout. And you can come up with all kinds of reasons why gold's going to go higher moving forward. Did an event not that long ago with the folks at Advantage Gold, which I have a lot of respect for if you want to own physical gold. But GLD could break to the downside out of this triangle, at least short term. So maybe gold breaks down and catches up with silver that way. One of the two things is going to happen, but the two are likely to come back into concert with each other in the not too distant future. And then if we take a look in the energy space, gosh, just UNG just can't get its act together. It's trying. We've talked about natural gas so many times. We had the bid when it became apparent that, oh, yeah, all these data centers that are going to be built are going to be using natural gas. And we had this bid, and then we had the tariff tantrum and companies saying, oh, we're going to delay our production of new data centers. And we have the unknown of how fast can they be built and how much natural gas are they going to use? So we had this downward zigzag here, another zigzag, right exactly to the 161.8% extension. Look, this is why I talk about zigzags all the time. You really want to watch that recording of the Zigzag Masterclass. You want to learn more about this and put it in your trading repertoire. It'd be a good addition to whatever trading system that you utilize. So click on that link and watch that recording. But we had a bounce back up and we've gone through and created another consolidation. You can stay cautiously bullish on natural gas as long as we hold this 15 level. But if we give that up, we're probably coming down to 12.5 rather quickly. So we're just barely clinging on to the possibility that we could break to the upside out of this triangle on natural gas and move higher. If we move to oil, once again, so the energy space all has triangles. And I've drawn this, and I've shown you this a couple of times here, the triangle on USO. Now, what I did in our insiders meeting last week, which is for alert subscribers only at ewotrader.com, is change the position of where this triangle could be. And by the way, we're giving away each and every month this year, just like we did last year, a free subscription of our level 3 at ewotrader.com. And that includes our time strategy, which is looking for income-based strategies, sideways strategies, if you will. And then the volatility strategy, which is looking for breakouts of these triangles. You don't pick a direction, you just need it to break out. We have a unique way of doing the triangles that mathematically means that it will move as fast as possible. And then the AI-based directional strategy, the impulse strategy, which is highly focused on those zigzags within the wave 3. All you have to do is post a comment underneath this video and you're registered for this month's drawing. This is the last weekend for this month, so leave a comment and good luck to you. But as we come back to the chart of USO, this is one of the things that I talk about a lot, and you can see that perhaps you could draw this as a symmetrical triangle, where you have that high back from early April, and then we come down with the lower highs, and we have the higher lows. Or you could look at this and say, no, I would rather draw the upper trend line here and show this as more of an ascending triangle. And some of you make comments at times that you don't agree with exactly where I draw the trend lines in triangles. And to be honest, I don't care. I'm not trying to be that specific, that technically correct. What I want to know is this issue, this security, and it's optionable because I like to trade options, in a consolidation period. And it doesn't matter whether it's ascending, symmetrical, or descending. All these triangles can break either direction. So whether or not you prefer this to be drawn as an ascending triangle or a symmetrical triangle, I submit to you, it makes no difference. It just means it's consolidating, it's going to break out. So oil is going to make a significant break at some point in the not too distant future. So that's something I'm watching really closely. And there is a viable strangle that you can put on USO right now, or you can just wait for the breakout and trade it moving forward. All right, so as we start looking at stocks of interest, and gosh, there's a lot of them to talk about. We'll start with Google. And with Google, we've gotten a little bit of renewed bid. As you remember, on this way down, we were talking about how it just seems like every other day there was some sort of a regulatory negative that was coming out, whether or not it's here in the US or whether it was in the EU. But it seemed like everybody was attacking Google and they couldn't get away from bad news. And we had this wave 3 movement to the downside. We've gotten a bit of a bounce and we've been able to break above this resistance line here, just under the 170 level, and we closed above it today, so we've held that level. We're back above the 10-day moving average. This wave 4 is labeled here, but it's at the very last bastion of fib support, the 78.6% level. And if we can move up in Google and take out that wave 4 high, that becomes a disqualified 5-wave pattern. It's still barely qualified, so you do have to respect that Google could go lower. But how much more bad news can come out on Google? So if it can take out that wave 4 high, I think that's a nice looking trade to move up to that 190 level there. And Apple, the one of the big tech stocks that just can't seem to catch the bid that the other ones have. We're working our way down the wave 4 here underneath that 61.8% level. We tested it, thought maybe we might take that out. Nope, we've broken down. We're trading below. We're right at the 10-day moving average here. So we'll have to watch and see, because we are building a little more of an area of support here right around the 200 level. If Apple can hold this and bounce up, but I would submit to you, you don't do anything unless it takes out this wave 4 high. But if Apple can bounce up and take out that wave 4 high, then maybe we go up at least to 225 and maybe all the way back up here to 250. But it's got to do this first. For now, you also have to respect that we could continue down in this wave 5 lower. And any sort of follow through to the downside, we had this breakdown, but no follow through. We jump back up. That's why we need to follow through a confirmation day. But we could come down to this level here around 185 rather quickly. So Apple is precarious right now. I think you just need to keep that on your watch list and wait for a better entry. And then Palantir, gosh, they talked about Palantir yesterday. Somebody came out, I'm not going to mention her name, that said that she thought Palantir was the best short in the market. That was unfortunate timing, because then President Trump comes out today and announces that he's going to select Palantir to help with some defense spending that they're going to do, and you get this big upward move. If we add volume on the chart, you can see that big volume spike. So clearly there was some short covering in the move today, and that brings Palantir back up towards its recent wave 5 high. I know a lot of you like to trade Palantir, and if you want to go long, so far it's just short covering. Again, as you can see by that big bar. But if Palantir can take out this wave 5 high, because this wave 4 came down to 56%, right between 50 and 61.8, that wave 5 could go 100%. So there is potential for further movement to the upside on Palantir, but you want to see that wave 5 high from early to mid-May broken first. So again, keep a close eye on it, but certainly got the shorts off sides today for sure. Looking at Microsoft, I'm looking at this one because this has performed really well. From this big gap up that it had on earnings, and it's continued to move up and consolidating right above this resistance level at 450. Microsoft looks like it might be ready to extend that wave 3. If you want to see very bullish consolidation following a gap up, and I don't like it when stocks gap up because data shows gaps get filled. We don't know when. It could take a while, but they're likely to get filled at some point in time. And I can give you the numbers, but I'll do that another time so that we don't keep this recording too long. But I think that Microsoft could be a place to look moving forward. It looks set up really to move. And speaking of a stock that's been moving, look at Netflix. Holy cow, it seems like this stock just goes up every day. We've had a little bit of a give back here. We're consolidating above the 10-day moving average. We're still in the wave 3. When I see this, such an extended move, I want to bring that DMI in, and the ADX has been quite strong. It is starting to tip down a little bit, so I'd be a little cautious on Netflix now, even with this big move. At some point in time, it's going to have its wave 4, and the ADX is saying the strongest part of this run is over. It doesn't mean it can't go a little higher from here, but I think that you want to be a little cautious here. I would be interested in Netflix if it comes back down to test this support around 1150. But for now, it's just kind of a watch and see. And then as we take a look at Tesla, and it seems like the buyers of Tesla are happy that Elon's saying that he's going to come back to work at Tesla. He's going to give up his duties at Doge, or at least only spend, a couple days a month or something on Doge now. But this wave 4 is right at the 61.8% level. We need that to be taken out if you want to continue to be bullish on Tesla. So we had a nice run from that April low where we had the tariff tantrum low. We had back-to-back triangles, which I mentioned was very unusual. And then this really clean, long breakout from the second larger triangle. And holding above this area here around 350 is key. Right now, we're a little bit below it, but holding above the 10-day moving average. It does feel like Tesla wants to come back up and at least test 400, but we have to take out this wave 4 level first, and then I think it runs to 400 maybe in one day. It could be rather quickly on that move. And then to finish things off, I do want to look at the Nifty. I've been looking at the FXI with all the rhetoric between the U.S. and China, but a lot of you keep asking. I know we have a lot of viewers. We have a lot of subscribers at evotrader.com from India as well. And this is just such a cool chart here. It has a little bit of everything. So we had this 5-wave pattern to the downside. The wave 5 went past 100%. So you look for a 61.8% correction. We went right to that rather quickly, came back down, made a higher low, and have moved up in an old-fashioned trend channel. You just draw lines on the higher highs and the higher lows, and you get an old-fashioned trend channel. And look where we went, right back to a full 100% retracement of this previous wave 5. So right back to where that 4 was. It didn't have to do that. It only by rule had to go to 61.8, but it went up here and is having resistance here. So you watch this chart of the Nifty, and if we can break above this level, so let's round it up to 60. If we can break above 60 on the Nifty, I think the Nifty goes higher, and we could be looking at a move all the way back up here to the highs back from last October, back around the 63, 64 range. So keep an eye on that level right here on the Nifty. Thanks as always for your time. Have a great weekend. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.